Thank you for tuning in to this edition of Mastering the Math of Business with Lauren Young. Today we're going to be talking about a subject that is not very well understood and is actually one of the big difference makers between a business owner who enjoys life and doesn't carry around with them a lot of stress and those that do. In other words, they got a lot of stress, life's a burden more than a blessing, and they're just worn out all the time. This particular edition of Mastering the Math of Business will explain why that happens. And it's reflected in the balance sheet. You can tell a lot about a business by the balance sheet. And really what you're looking at is the mix of assets to liabilities and owner's equity. And there are a whole slew of financial ratios and different calculations you can do to gauge what's going on in a business through its balance sheet. But what I want us to do in this initial video is to just appreciate why you need to understand the balance sheet. And the primary area of focus is with regards to the assets. Who has first claim against the assets? That's the primary purpose of the balance sheet. It's recording what the resources are of the business as reflected in current and fixed assets. And then it lays out how much is in liabilities and how much is in an owner's equity, and the mix between liabilities and owner's equity will equal assets. In other words, this number will always be the function of these two numbers. And so the key to appreciate is that there are a lot of reasons why you would use debt to finance assets, why you would use equity or investments from investors in the business. But the point is, everybody expects some return. Your debt holders expect you to repay them plus interest. Your investors expect you to repay their investment with returns. The point is, if you fail to generate more out of your assets than what people have tied up in your business, you're going to have a lot of headaches. And so you protect yourself from headaches by making sure your assets are working harder than your liabilities and owner's equity. So let's appreciate this by looking at the P&L statement and the balance sheet. So the P&L statement is the workhorse financial statement. It tells you how the operations of the business are performing. The assets reflected in the balance sheet are telling you what the asset base is that's driving the operations. And then the liabilities and owner's equity are telling you who owns those assets. And as you can see, I wore a shirt reflective of the color of liabilities. And that's because everything goes great in a business when you're realizing your sales and profit plan. In other words, the primary purpose for your assets are to generate sales at a profit. And that profit's going to come back into your balance sheet reflected down here in retained earnings. So as long as everything is working well here, this is never a problem. But drop off sales, spend more than you should to convert those sales into profits so that you're making less here, and all of a sudden this becomes an enormous burden. So when I look at a balance sheet, I always focus on this part. What's here to drive this and this? And then I do look at this. I am looking at the ratio. In other words, how much of these assets are owned by the creditors and how much are owned by the owners themselves. But the point is, these assets are what matter. And so let's look at a narrative associated with the balance sheet. So here we got a business. This is actually a client, and this is their mix across their balance sheet in this plan year. So this is what they are expecting to end the year with. Now let's appreciate something that's pretty significant. Let's say that through the course of the year, this starts to underperform. In other words, it's not generating the sales it should be, and it's affecting the profits of the business. if that's allowed to continue for too long, that puts this at risk, the owners of this business will start to have real problems. And so don't let that happen to you. Make sure that your assets are working harder than you are. So let's look at the math to appreciate this. Again, you need to just know the mix of your balance sheet. The key number here, of course, is the assets. And then you're looking at your profit plan. How much are you planning to sell, and what do you expect to hold on to in those sales, i.e. what's your return on sales? The next thing you need to do to appreciate whether you're at risk on your assets is to really take a hard look and put a percentage against those assets that you believe are underperforming. In other words, for whatever reason, they're not carrying their weight. They aren't generating the sales or helping you convert those sales into profits, and those assets represent a drain on the business. And so let's appreciate what that drain looks like. Well, it could be a potential of $3 million in sales difficulties. In other words, you've got a goal of $12 million in sales. If 25% of your assets that exist to help you realize that $12 million in sales aren't carrying their weight, that's your exposure, $3 million. You put your return on sales against the $3 million, and that's your bottom line exposure. So again, you're putting a quarter of your profit plan at risk anytime you have underperforming assets. Yes, there are a lot of other calculations, and many of the wizards of Wall Street would tell you they have a lot better ratios that they'll use to assess a business through its balance sheet. But what I want you to appreciate as a small business owner is that your assets exist to support your business. And so you want to make sure you've got performing assets. That's the big key here on the balance sheet, is how much do you have tied up in assets, and what are they doing to contribute to net sales and net income? The call to action associated with this video is to really pause and ask yourself, are your assets working hard for you, or are you working hard to pay for them? If you find yourself struggling to keep up with your loans and lease payments, in other words, your debt obligations are a real burden on you, then I invite you to go to businessfitnesscheck.com and take our business fitness test. Take our business fitness test. It's similar to a physical. So you'll go to your doctor to have your health checked, and they'll screen you on a whole array of factors to get a sense of whether or not you're at risk of any health issues. And the big one they're looking at is what? Is how healthy is your heart? Well, the business fitness test is designed to help gauge how healthy your business is so that you can appreciate what your risk level is to suffering a business cardiac arrest. And a business cardiac arrest is simply defined as you're not generating enough profits, and as a result, you don't have sufficient cash flowing through your business that puts you in cardiac arrest. So go to businessfitnesscheck.com, take the test. You'll receive back a risk profile for the next 3 years of how exposed you are to suffering business cardiac arrest. Thanks again for tuning into this video. I do wish to end with the standard asks. One is questions, comments, ideas for other videos, all welcome. Appreciate that these two statements really do shed a lot of light on your business. In fact, the point that I would like to make is that your business, through the numbers that are being reported in these two statements, has a lot to tell you on what's going on. If you just pause and look at your numbers, they're a reflection of what your business is trying to tell you what's happening to it. With all videos, likes are appreciated as well as subscriptions. Subscribers will be exposed to the upcoming series of different ratios and different ways of working with your balance sheet to maximize your sales and profits. So subscribe and be exposed to them. Thanks again for tuning in. Do appreciate it. Bye.